You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding Options Insider Radio Network. Let me mention once again those new additions, including Options Playbook Radio, where we break down some option strategies and some interesting sports metaphors. If you want a short little weekly dose, about 15 minutes or so, of option strategies in your iPod or iPhone or whatever you listen to, Android player, I don't want to exclude you guys out there, then check out that program. I think you'll like it. And of course, if you're all up in arms about all the furor going on out there in the tech side of the space, HFT, all of that fun stuff. Check out Trading Tech Talk. We dive into all that fun and amazing tech that is powering all the trading we talk about here on programs like this and all the other programs on our network. All right, and joining me on the old Volatility Views panel today, starting off with the man beaming in from scenic, sunny, and suburban Virginia, none other than the research major domo over there at BGC Partners, Mr. Jared Woodard. Jared, welcome back to the show, sir.
Hey, Mark. I'm always happy to be here.
Did I get that right? Are you beaming in from Virginia today, or are you from parts unknown?
I am in Virginia, doing my analysis work here.
Sounds good. And beaming in from a little bit closer to home, we are also joined by Mr. Mark Sebastian from OptionPit.com. Mr. Seabass, welcome back to the show, sir.
Hey, thanks. Good to hear you. I'm coming in, obviously, from the home office in beautiful Chicago, Illinois. So at least we got that going for you. That's why I'm a little less tinny today, I suppose.
A little bit less tinny. Whenever you beam in from the worldwide HQ, you do sound that much better. So we always appreciate it here on the old
Well, maybe
network.
just because I'm so much closer
That's
to you.
true. Could be it too. Riverside, you're about 300 miles out there. By the time that signal gets here and back, who knows what happens to it.
Exactly. I mean,
who knows what kind of wires they have out there.
3 miles outside the city really makes a big difference.
It's huge. Skype, very latency sensitive. People talk about high frequency trading, but low latency telecommunications and recording for radio is really where the driver is these days. All right. With the team assembled, we're going to dive right on into our first segment, the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, you know what that catchy tune means. It's time once again for the Volatility Review. This is, of course, the portion of the program where we break down the week that was. from a volatility trading perspective. We are recording this on Friday, June 6th, D-Day here, listeners. So you'll be listening to this on the following Monday for all of you playing the home game and like to know the dates as we are recording this. It is yet another relatively quiet day. Actually, seeing a bit of a sell-off from a volatility perspective, of course, going into the weekend as well. Not surprising. But from a week that was perspective, starting off as we are wont to do in VIX and VIX Cash land, there wasn't a whole heck of a lot going on. There's a lot of vacillation, mostly around that 11.5 handle. Got a little bit lower, like we're doing today. Got a little bit higher earlier in the week, around the 12.5 range, but not a whole heck of a lot aside from that. Mr. Jared, I think we'll start with you. What, if anything, caught your eye in this week that was from a volatility perspective?
Not a lot, to be honest. There was a lot of sideways action.
Let's just go home right now. What do you think?
Yeah, have lunch and call it a day. I mean, the theme we've talked about the last couple episodes, I think, of low volatility, both in realized and implied terms, continued on, and people kept talking about those facts, and some people talked about them in more dramatic terms than other people, and I think that for me that kind of is the perfect encapsulation.
Mr. Sebastian, what about you? What caught your eye in the week that was out there in VIX land?
Yeah, I mean, it's just been the VIX continues lower, and I think that we may see a 10 handle here, possibly even by the time we're done recording this episode. We're right on top of it, but the idea that there's any uncertainty out there. And the other piece is that the VIX continues, even at 10.5, would be nicely overpriced by 2.5 times realized volatility in the last 10 days. So it's not like the VIX isn't pricing in some sort of increase in movement.
That's right. I looked this up this morning. So with the S&P realized vol below 5% over the last 10 days, that was since like 1950, that was in the bottom, I think in the 5th percentile. Since 2000, it's still off the top of my head, but I think since 2000 it was in the bottom percentile of realized volatility value. So, it's true that S&P realized vol is extremely low, but like you say, Mark, in terms of that comparison between implied and realized, if anything, the argument should be that the VIX is too high, too overpriced.
I know it should be a 6, but that we obviously at a certain level it does hit kind of a bound where. At a certain point, it's impossible to sell. What ends up happening is kind of like when mortgage rates got to like 3%. There may be a scenario where it trades there, but things are so cheap that, you basically can't. So, I liken this VIX level to the market's basically pricing insurance prices like the stock market is, a 30-year-old, perfect health male that has a wife and a couple of kids that's, that super high life expectancy. And the only thing we don't know is whether it is that healthy 30-year-old male or whether the market is a 85-year-old cigar-smoking drunk that has a Camaro. My guess is for the next couple of months, maybe we are that healthy young man. But I think there's a chain-smoking, Camaro-driving, octogenarian drunk somewhere out there, don't you?
This is why we have you on the show, Mark. Always handy with the colorful analogies for the show. I think that's a good one. There's somewhere there's a Winston Churchill in a Corvette out there lurking
exactly.
Somewhere down the horizon. I like that image. It's very disturbing in my head right now.
Well, I just love that he has a Camaro as
well.
Yes,
there's all sorts of anachronisms floating around in there.
It's an IROC Z actually, and it's a late model. It's an '88.
But you're right.
I was going to ask whether it was like a T-top or like a hard top. What's the nature of that Camaro? But I guess
Churchill was never shy of publicities. I think he'd want the top down.
Well, no, it's absolutely a T-top with the little whale fin in the back, just for and maybe just maybe it's got the super low profile tires. I haven't decided on that yet.
I could certainly see all of that. You're right though, Mark, and I saw you did. I think you retweeted something this morning about how can something along the lines of how can VIX be cheap when it's 7 points higher than the 10-day realized vol. Of course, the 30-day realized vol not much higher. It's still 8. So when you're looking at a VIX as we are recording right now, VIX Cash 11.06, just a hair above breaking through the 11 handle there into the 10 handle range. it is interesting to see these levels. I think we tweeted something out earlier today or yesterday joking about that's along those same lines about saying, hey, realized vol is so low and my VIX is too low. Really, we think it's actually a sale, and people got very up in arms about that. They said, oh, realized or implied vol always trades at a premium. A lot of people wrote in very, very irate about that. So apparently, when you say that VIX maybe isn't too low here, people apparently get a little up in arms about that. Of course, we talked a lot about that last week on the show about VIX. Is it too low? Is it not too low? What sort of persistent drumbeat are we seeing in the media as a result of that? We saw some interesting stuff continuing that drumbeat. Of course, this week, we have some interesting listener mail and comments about that a little bit later as well. But we did see something coming out of a couple of different outlets, including our buddy there, Brendan Conway, who used to be the options writer over there at the Journal, now does the blogs over there at Barron's. He's one of the few people who should, quite frankly, know better, and he does. He cites some people in his article, including a group I'm not familiar with. I believe they were called the Bespoke Investment Group. I think they're an analyst group. They start off by saying since 1990, the VIX has been at its current level or lower just 4% of the time. So you think they're going to go one way with this analysis. But of course, they do mention that, as Brendan mentions in his article, that maybe this drumbeat is being a little bit overdone. Kind of exactly what we said in our show last week. The takeaway here is that investors shouldn't expect the VIX to get much lower than it is now, but its low level is not necessarily a sign that we're due for an imminent spike up to 20 or higher either. And I just like seeing that somewhere in the broad financial media, because that drumbeat that it has to revert to 20, has been so incessant. I think it's really going to start driving some people, particularly on the retail side, to start doing things that they shouldn't be doing, like loading up on VXX. I did see an article I think we might even have it here in the show later, from, I believe it was our friends at Bloomberg, recommending an upside vertical in VIX because it has to mean revert at a certain point. So that kind of stuff gets a little bit dangerous. I know we've mentioned it here on the show, but we're kind of preaching to the choir. People who listen to our show hopefully already know better. But there is indeed quite an extensive carrying cost to this trade. And if you are going to load up on VIX, you're going to load up on vol in some way, shape, or form, be prepared to have to roll. I think Brendan pointed that out in his article as well. He said back in 2005, market bears were constantly harping on the fact that the VIX was so low, but it stayed low through early 2007 before we saw a sharp spike. So bear that in mind, a year and a half plus in terms of volatility malaise, listeners, when you're seeing all this information about the long-term average being 20. We've already kind of debunked that on the show in the past, but if you're one of these people who's prepping for an immediate mean reversion, immediate spike in the VIX, maybe you take some time, because it could very easily stay here for quite some time. And then all those options you're buying, whatever futures, whatever you're picking up to spec on VIX, is going to be a heck of a carrying cost involved and quite a few rolls involved in the near term. Some other interesting data coming out of VIX land right now, of course, is that CFTC tracks a lot of the net futures positions out there. Everyone talking VIX is too low, VIX is too low. Well, apparently a lot of the large speculators out there don't think so, because they've added quite a few short VIX futures bets in the last period. The CFTC obviously releases their commitments of traders reports on a regular basis, and they noted that large speculators were net short almost 82,000 contracts on the VIX futures. This is, of course, from last month. This is the largest net short position they've tracked since October of last year. So interesting that the persistent drumbeat is beating one way, that VIX is too low, has to go north, and yet some of the size traders on the future side saying, you know what, they can see the numbers, they can do the basic math, realize vol is 4 10-day, 8 for a 30-day. They can do that math and say, you know what, I actually want to be leaning a little bit short here. Do those numbers surprise you at all, Jared? Is that pretty much what you expected?
No, I think that's a great point. This is a statistic that we track with every. It comes out every Friday, the update, and I watch it pretty closely. I can say that in terms of predictive value, it's a little bit unclear. I looked at this last year, and at least at that point last summer, there wasn't a lot of predictive value in these changes in positions over the short term. But it is definitely interesting to watch from a standpoint of, well, what are people thinking, and how are people positioned? What's especially valuable, I should mention too, about that CFTC data in this case, is that VIX futures is kind of a closed loop. I mean, there's other ways to trade on vol, certainly, but if you're going to trade VIX futures, this is where you do it, which is not the same. The same thing can't be said for things like futures on currencies. A lot of people look at the FX data that the CFTC comes out there in that same commitments of traders report. And, given how much happens over the counter, I think the value in the currency side may not be as clear, but in the case of VIX futures, I think it's definitely worth watching. And the fact that people are, these large speculators are positioning so much in on the short side, it does kind of give some credence to that point that there's significant carrying cost, or if you want to talk about it in reverse, significant premiums to be had from being short. And I would mention too that if you look at the long side data, the amount of long exposure among those same speculators, that's also been rising this year pretty steadily, and it's been rising at a pretty steady pace. And I think that's worth noting as well, that even though you're seeing high short exposure, you're also seeing the long exposure creep up in ways that it hasn't done in years past. So that may mean that people are a little bit more hedged or kind of less unidirectional than they had been in years past.
You're right. I think it's an interesting indicator as well. We've kind of struggled with what to really do with it here at Options Insider. We do a lot of futures-oriented content as well, and it's very much a lagging indicator. So it's interesting from a theoretical perspective, and it's certainly informational to see what people were doing in the previous period. But you're right, in terms of predictive value, I'm not sure how much is there. But still, it is one of the few data points you can find that directly contradicts the drumbeat we've been seeing out there, which is always interesting to see for us here. Speaking of VIX futures, it's that time of month, of course, where the numbers are coming out for the May time frame. Even though there was a little bit of activity out there, it wasn't the best month from a volatility and from a VIX futures perspective in particular. The ADV in VIX futures was 143, nearly just a tick shy of 144,000 contracts a day. That's 1% down from May of 2013, and actually a 19% from April, which was a relatively rocking month from a volatility perspective, at least compared to May. Total trading volume in VIX futures, a little bit over 3 million contracts. That's a 6% decrease from May 2013, and again, a nearly 20% decrease from April of this year. And year to date, VIX futures totaled 19.14 million contracts. That's actually 16% ahead of last year, and the ADV of about 185.8 thousand contracts a day is about 17% ahead of the prior year. But again, like the bulk of the brokerage industry and the bulk of the derivatives industry these days, a lot of that strength coming from Q1, where we saw, of course, the Ukraine crisis and a lot of volatility in the market. S&P was really moving, so volatility really had some life to it, and that's bolstered us through a Q2 that was relatively lackluster. We'll see if Q3 can start to really pick up the pace here for us going forward. Speaking of picking up the pace, VIX options also still doing fairly well. Of course, the volume, ADV still strong, about 640,000 contracts, but not as high as it has been in some recent months. That's not exactly surprising given the data we just mentioned coming out of the CFE about the futures. VIX also still very call heavy in the options, but a little bit less so. Remember we mentioned last week it had spiked up to about 3.4, which was a 6-year high, I believe, and then it was trading around the 3.3 range, now coming off a little bit again, down to 3.2. Again, we don't put a heck of a lot of stock in that here on the show, but a lot of people still are very interested in that indicator, so we'll see if that maybe continues to lessen in the near term, though again, if VIX stays in this range, I don't really see how that's possible. It's really pretty much all calls all the time at this point, just because there's such a dearth of strikes to the downside. We talked a little bit on our option block program yesterday about non-farms and about how it really wasn't the event from a volatility and premium perspective that it has been in weeks and months past. Mark, did that kind of surprise you that going into the non-farms, we didn't see a lot of action, didn't see a lot of people bidding up premium in the S&P, or even in something like VXST, a product that's ideally suited for speccing on and hedging against an event like non-farms? We saw open interest coming off out there as well. Did any of that surprise you?
Well, it was telling more than surprising, if that makes sense. Here we are on a day where basically nothing happened out of non-farms, and the market and vols getting just collapsing. So the market was expecting the market was expecting the expected. So nothing happened. And but one of the things is, we had this long talk heading into the ECB meeting. I just kind of for fun, I put together a trade. Jared, you'll actually kind of like this, where I bought the June expiring on the regular June, at the money straddle, which at the time was, I want to say 9:15 or 9:20. Does that make sense? Then I sold VXST 13 calls at 85 cents, and I sold 30 of them. And the reason why I sold 30 is because, and this is all theoretically, I didn't actually execute this trade. I just want to kind of show my option people kind of how you could potentially use VXST into an event. And I sold 30 because my straddle had my straddle had 3,000 Vega. So, and I used the VXST that's expiring next Wednesday because the VXST that expires next Wednesday should correspond exactly to where that June expiration volatility is. And what ended up happening was I broke even on my SPX straddle, and then I won on my VXST. And if I'd done, obviously if I just straight up done the VXST on its own, I would have won, but I would have had all kinds of risk on the table. And if I'd done the SPX, I would have been break even and, wouldn't have made anything. But as a combo, I was able to take advantage of the gamma and take all the Vega risk off. In this case, it really wasn't all the Vega risk. I should have, if I really wanted to take the Vega risk off, I could have sold like 2 futures. That would have done a better job. But, this was kind of a backdoor way of hedging off my Vega risk in VXST and in SPX.
That is an interesting trade. I like that idea. I'm just thinking about what you just said. I'm trying to think about the dynamics there in my head. I think these volatility trades into events have just become less and less explosive. A lot tighter as the environment's calmed down. But I would argue, this is a little bit maybe contrarian, but I think you could argue for a little bit of something that happened today in today's non-farm release, and that was the lack of an explosion upward in average hourly earnings. A lot of people are talking about hourly earnings as one of the key indicators that would be something that would motivate the Fed to become a little bit more aggressive, to move their timetable forward a little bit if they saw some really meaningful signs of inflation at the earnings level. We didn't get that today. And so if you're a market participant who's worried that the Fed's timetable is going to change in a meaningful way from where it has been, maybe you're worried that the earnings data would come in too strong and you'd have to kind of adjust in that respect. So the fact that the hourly earnings were pretty tepid maybe isn't a very, very positive sign for the economy overall and for the long term, certainly. But in terms of short-term market positioning, if I had to get long or short on today's data, I would take it as a sign to stay long and maybe get longer, just because you feel like the Fed can stand pat for its current timetable versus where it was yesterday. So if you need an explanation for the market move today, that might be it.
Jared, I'm just curious, as you spend a lot of time tweaking your models and looking at your indicators, has the, you call it softening, I suppose, of interest, or the dynamic nature of non-farms these days versus what it was a year or two ago, has that caused you to perhaps rethink its place in some of your models and its importance? Have you maybe downscaled it a little bit as a bit of an indicator for you, or you still treat it as essentially the same level of importance and significance? I've had a bit of an education personally on this over the last year or two. I think it's a really fun kind of a parlor game to look at non-farms and to guess the number and do that kind of stuff. But in terms of usefulness as a predictor, I don't think it's actually that useful. There's the standard criticisms apply here that there's this huge margin of error. The number is almost always revised in a meaningful way after the fact. So if they released it with a 1 month lag, then I think the number would become more meaningful on its release than it has been. But even beyond that, I think you have higher frequency indicators that are more valuable. Initial claims is the big one. Tax receipts is another big one. And in terms of leading indicators, I think those come out more frequently and are more meaningful when the data is actually released than the non-farm number. And I would mention too, in terms of thinking ahead, someone mentioned to me today that July might be a little bit more of an interesting release than usual, and only because the ECB is scheduled for the same day. So it's July 3rd, I believe. And so if you get those two events going at the same time, I'd be surprised if we didn't see a little bit more premium in maybe the euro ahead of those two numbers than we were looking at
even this week. So I think it's something that'll be useful to watch from a trading perspective, even if non-farms isn't so key from a longer-term economic point of view.
Yeah, that gets back to the point we were just making earlier about the commitments of traders out of the CFTC. There was a time when that was very important market-moving data, but as anyone who's read Flash Boys and watched the media, watched the news of late knows, the market is a microsecond, millisecond market now. It's not these weekly and monthly indicator-type markets anymore, so the importance of those types of events seems to have been somewhat subjugated by other events that come out on a much more frequent basis that people can digest and act upon in a much more frequent and perhaps relevant manner than some of these big former events. Just to wrap up here on the VXST, I was digging through some of the numbers while we were talking here, and again, a big non-farm day. This is the day when ostensibly a product like this should be very popular to both hedge and spec on. And I'm looking at the numbers today, and they're doing so far they've only done about 70 contracts coming out of the non-farm. This is the product that still only does about 550 contracts a day. And the biggest trade so far today is someone unwinding a 25 lot of the June 13 calls that they sold for 40 cents. So, and that looks like that was probably closing. So maybe someone specking to the upside here and taking it off. But that's really about all that's going on so far today. And we're well into the session here, listeners. So VXXT, not exactly lighting up the tape. Of course, non-farms didn't either. So perhaps you could tie those two together. And just wrapping it up here in VIX and VIX related land, we always check in with RVX as well. That is, of course, the Russell VIX, the Russell 2000 VIX. And as I mentioned earlier, open interest is looking pretty strong out there. It's still looking pretty strong, creeping up north again to that 5,000 level. That seems to be the barometer out there. Even seeing some trades going up again today. So RVX, good signs of life, including, which I think is interesting, and you'll see why when we get to the listener mail later if we have time, listeners, including 100 lot of the June 32 halves open. One of our listeners will find that very, very interesting, and just the prevalence of call activity out here in RVX. I talked about that before. Really not a heck of a lot going on in the puts, and then someone piling into 100 lot of these pretty far out of the money, pretty near term calls as well. Interesting stuff. We'll get to more in a little bit about why that's interesting. All right, moving on to some other topics. We can't hit the volatility space, the volatility ETF space in particular, without touching on some new additions to that space. Jared, I'm sure you'll find these interesting. Our friends over there at iShares launching 3 new volatility ETFs because there weren't enough already. We had to add a few more to the equation. Of course, these aren't just your standard 2x, 3x short VIX or whatever the case may be. These are actually looking at the international perspective, which is, I think, a little bit interesting for our perspective here on the show. This is the iShares Asia X Japan, so Asia without Japan, minimum volatility ETF, that's AXJV, the iShares Europe minimum volatility ETF, that's EUMV, and the iShares Japan minimum volatility ETF. So they thought there's enough going on in Japan from a rates and from a volatility perspective that it should really have its own index. These use a quote-unquote smart beta strategy that will screen the universe of stocks for low volatility, value, and quality. So, and quality, that's not a subjective term. I know, Jared, you do your own international volatility tracking with your market tracker and your vol tracker. You think these ETFs will play any part of that going forward?
Well, correct me if I'm wrong. These are equity funds, right, that use some of these different factors, quality and minimum volatility and stuff to select assets? Is that the idea? That
appears to be the case. I didn't see much mention of them using derivatives in there. I mean, you might be able to imply that from the name, but you're right. Sometimes when people throw around terms like volatility, it's very much more from an equity perspective, and the actual use case from an options and the volatility perspective we talk about here on the show could be somewhat minimal.
This was an interesting idea, an interesting concept of this minimum volatility, low volatility investing. I think the last couple of years there was a good book on this. I forget the Eric Falkenstein is the author, and the title was something about the missing risk premium, something about this low volatility anomaly where on traditional CAPM kind of finance 101 perspective, you would be compensated more for taking more risk with an asset, but in these studies we're showing that investing in stocks with low volatility actually saw the same return over time, so that in risk-adjusted terms, they actually looked comparatively much better. So you had some funds launching in this way, and I wonder if these ETFs are looking in that same direction in terms of trying to invest in assets that have low sort of realized volatility to capture maybe the same risk premium, but with less standard deviation. I mean, so if that's, I mean, the problem people encountered with this idea is that usually there are some important fundamental reasons, qualitative reasons why a given asset has had low volatility over time. It's not like they're just magically created out of nothing. And so I know in the case last year, when you saw a lot of the defensive sector stocks, utilities, things like that, when the rates environment started to change or the expectations for rates started to change, you saw some of those defensive stocks get hit pretty hard. So even though they looked great over, let's say, the trailing 5 years from a low volatility screen, when the macro environment just took a slight turn, those stocks got hit and suddenly they didn't really qualify anymore. And so I know some of these low volatility funds saw worse returns than I think people had expected. And it may be that these new ETFs correct for that or have a different combination. But it goes back to that same idea that there's always fads in the market. There's always things that become more and less popular. And I know that risk parity was a major topic for a long time. This low volatility phenomenon has gotten a lot of attention. For me, I think there's nothing wrong with those, and they're certainly worth exploring. Although, as with anything else, you kind of have to keep an eye on whether the factors driving those returns persist or whether they're just kind of something cyclical.
Yes, always interesting to have new names to bandy about here in the volatility space, even if it is getting a tad crowded, shall we say. All right, moving on to some other areas of the market. I know a lot of you out there listening also trade other products aside from the broad equities and indexes. And so looking at the currencies, we touched a bit in the past how there wasn't much going on from a currency and a currency vol perspective. Well, that's starting to change a little bit, particularly this week. We saw the euro hitting just a hair above its weakest it's been in 3 months. As you might imagine, with that drop, you saw vol spiking out there. In fact, the JP Morgan's their global FX volatility index, that's not just the euro, but that's currencies across the board, that rose for 3 days in a row this week. It reached about 6.55, which is a pretty high level. It's actually the highest since we saw earlier in May. That number, we talked about earlier in other shows, had dropped off significantly. It almost broke through into the 5 handle just at the end of May and has since spiked quite a bit. Of course, a lot of that specking on what the ECB was going to do later this week. And of course, so a lot of that currency vol coming as a result of that. Jared, I know you watch FX amongst all of the various products that you bake into those trackers you're running over there at BCG. What's your take on this interesting back and forth we've seen in euro, in addition to broad currency vol, euro kind of moving around a little bit, giving us some life, ECB also giving a spark of life, a hint of volatility back into those currency markets?
Two things on this. One of the interesting parallels between implied vol in the euro and implied vol in U.S. equities is that it's extremely counterintuitive to want to be a seller of volatility, to be short options in the kind of environment that we're in. And so I think even more maybe than in the S&P, all of this year, traders have been selectively buying premium in the euro, looking for some kind of a decision out of the ECB that would spark a new trend. And they've just been really disappointed. I mean, I had trades on like this last year in this kind of vein. And it's just one of these cases where quarter after quarter, you just can't find anything, any move big enough to justify the gamut that you're buying. So it's in many ways analogous to the situation in equities right now, that maybe the most painful trade, also the most effective trade, has been to be short vol, as unpleasant maybe psychologically as that is. This week was the same story where the decision came out. The euro did move, as you say, in the short term intraday. It saw a nice move, but then it reversed higher, and so premium sellers were handsomely rewarded. Premium buyers, unless they were extremely nimble, I don't even know if you could have gotten out with a meaningful gain on the intraday move. And I think that's an interesting thing to note. Eventually, maybe it won't be true, but for now, I think that the best trade is still the painful one. The other thing, we saw a big surprise rate decision from the Bank of Mexico this morning, a 50 basis point rate cut. And that's another trend to watch, I think, this year. Emerging markets are still grappling in some cases with how to get their economies out of stall speed. They can't rely on China anymore, and the Bank of Mexico cited that factor. And I think that's something that could be a continued drag for them. So if you invest in emerging market equities, I think that given this environment, it's a good idea to be selective about what countries you're looking at, maybe avoiding the most broad indexes for buy and hold investments for now.
All right, and moving on from currency land into the other land that I know a lot of you listeners out there like to play in. That's, of course, the metals, in particular gold. Gold has been where the action and some of the disappointment, the heartbreak has been of late. I know a lot of you diehard gold bugs don't want to give up the ghost, yet gold's been taking it on the chin of late. It touched 1240, a little bit north of 1240 an ounce on just a couple of days ago. That's the lowest we've seen since January. Of course, in spite of this relatively protracted sell-off, we've seen a little bit of stabilization of late. We've seen, looking back, we talked about the realized vol of the S&P earlier. The realized vol out there in gold, when you extend it out to 60 days, has dropped below 13, about 12.84. That's the lowest we've seen since April of last year as well. So if you're looking from a vol perspective, it's kind of interesting seeing this pronounced sell-off in gold and now the vol actually coming in as well. So on the flip side then, if you're perhaps along a gold bull and you've been beaten up a lot and you're finally maybe willing to give up the ghost or hedge some protection, it may not be the worst time to do that. Overall open interest in gold also taking it on the chin as well, falling to a 5-year low. That was back in April. And the ETFs that the ETFs that are backed by gold and the metals actually contracted as well by about 2.6 billion last month in April. So a lot of factors aligning against gold here. And Mark, I know you have the gold course. It's aptly named, but it doesn't really apply to the metals. But I know you guys touch on it quite a bit over there at Option Pit. I know a lot of your clients and mentees are active, not so much in the big gold futures options, but very active in GLD and SLV. So what's your take on what we've been seeing out there in gold, kind of the free fall it's been in for a while, a bit of the stabilization now, and also the resulting collapse of vol that we've seen out there?
Well, Mark, let's not forget that I am, in fact, still the manager of the mini metals.
That's true. I totally forgot about that.
And so I am still actively involved in this process. It's very important to me. So
mini metals, the world's best, shall we say, small-sized metals cover band.
Little person band, we prefer. Yeah, gold vol continues to sink, and the one piece to remember is when volatility is rising in equities, typically equities are falling. When volatility is rising in a metal, typically that means they're rallying. So this sinking volatility points toward, probably some continued pressure on gold, and I think continued pressure on the overall market as a whole, or in precious metals, silver, gold, platinum. I think you're going to continue to see those down for some period of time. GVZ is now getting back to those 13 levels that are extremely that are toward the low end for the name, and that is just one thing I'd be watching.
Interesting stuff. Again, not the trend you might expect given what we've seen going on out there on the underlying of late, but that speaks maybe to some at least interesting developments, interesting opportunities for those of you out there who are looking at some of the options and indeed the futures out there in gold. All right, that is going to do it for our volatility review for this episode. And now we're going to keep on rolling right on into your segment because it's time to fire up the old volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, like the man said, this is the portion of the show where you guys get to join us here on the Volatility Views panel, make your thoughts, your questions, your comments heard. A lot of great ways for you guys to do that, like we just said, or like he just said. So check those out, just like some of your fellow listeners did today. Starting off with the listener goes by the handle Angelthorn, and he writes, great show last week, guys. Finally, people not afraid to stand up to the VIX is cheap hype machine and back it up with some data. I'm going to sell some vol in your honor. Well, thank you for that, Angelthorn. And you're right. That's one of the reasons why I pointed out Brendan's piece this week, just because there is a dearth of people out there really taking the other side of this argument that perhaps it isn't cheap. Perhaps we're in this period that is relatively normal. It is certainly to be expected given the realized vol we're seeing exhibited in the marketplace. And perhaps the VIX isn't going to immediately pop back to 20 like a lot of people would have you believe. So in that case, I think we stand relatively alone. Nice to see that we have some support out there. And a lot of people wrote in with similar sentiments. So I just picked Angelthorns here from amongst the pile. So there you go, Jared and Mark, getting some love from the listeners for standing up to what they call the VIX hype machine.
I love it.
As do I. The VIX hype machine. No, it's the media hype machine of the VIX. The VIX doesn't hype anything.
Yeah, the VIX doesn't really need to hype anything anymore. The media does it for them. They just sit back.
Exactly.
They sit back and watch the contracts roll in, and they're pretty happy doing just that, I would wager.
Isn't that an old Cars song, Let the Contracts Roll?
Yes, I think that is exactly.
Let the contracts roll.
From the early 80s, the early days of listed derivatives, they were ahead of the game, that Rick Ocasek and those guys.
Yep, great tune.
I could sympathize with a journalist covering the options markets here. Absolutely. If you write every day that nothing's really happening and the VIX is at 11 and that's not really a big deal because there's a natural floor and the end, that's not really going to get anyone's attention. And it's not going to be, you're going to write the same story every day. You need something to talk about. And at least, it's a fact that you've got nominal low levels in VIX. And so that's something to hang on to. And, you see a couple places where people talk about the low realized vol and kind of give some more context. So, I think a lot of these people covering the market are doing a pretty passable job in most cases. If you wanted to talk about this in Taleb terms, God forbid, we could say that if your job is to generate interest in a story or in a market, then paying attention to the cost of carrying a long VIX position is not nearly as helpful as focusing in on and sort of magnifying potential sources of risk, right? Because that really gets people interested and it gets attention. So I can totally sympathize and totally understand why, if there is a bias or any kind of leaning in a particular direction, why it is what it is.
That's the age-old problem for derivatives coverage in the broad media in general. The notion, the article you're never going to see is, options are uniquely suited for risk management tools. You're never going to see that. You're going to see the derivatives blow out your grandmother type articles all the time because they're sexier and more salacious and they get read and they get clicked on. Whereas, derivatives used in appropriate fashion, that doesn't really ring anybody's bell. The same thing with the VIX is too low and could stay here for a long time. It's not as salacious as perhaps. Could we mean revert back to 20? Here's a guy talking about buying an upside call spread. Go check this out. That's much more salacious. That gets a heck of a lot more clicks than the latter. All right, great comment there, Mr. or Mrs. Angelthorn. I don't want to presume. Next up, we have a question. You guys will like this. Next up, we have a question from George Soros himself. So apparently a famous financier is listening to the show. Of course, I'm not sure if George is rocking a Hotmail address, but maybe. You never know. He could be trying to go incognito, even though he's using his real name. All right, and he writes, I do not know whether the VIX index or the implied volatility and historical volatility of the SPY ETF is a better indicator to make sure where the SPY and indeed most assets are headed. How do you use these indicators together for your work? I would use other indicators too, such as moving averages, volume, underlying price, relative strength, and other major supports and resistance levels of the underlying prices. Thank you. Regards, George. Well, Mr. Soros, we've gone on at length. I have, certainly, on this program and others, about my, shall we say, I wouldn't say disdain, but lack of use for a lot of other technical indicators like you've mentioned here. But that said, there's no reason why you can't, if you're interested in those and follow them, you can't incorporate them along with the things we talk about here on a show like this: low levels of implied volatility, low levels of realized volatility. All of these things should be in your toolbox, and I think a lot of us here would argue that the latter, the volatility levels, are probably a lot more useful and a much better indicator than some of these other things like relative strength and others that have been bandied about for ages, and there's a lot of pros and cons and debate about whether they're actually useful. So Jared, I won't go too much into my viewpoints on technical analysis, but Jared, you probably do the widest range of research here on the show, use the widest range of indicators. What's your take on what our friend Mr. Soros has to say here? Do you factor all of this into your analysis when you're looking at your research, or in addition to, the levels of implied volatility, levels of skew, levels of realized vol, et cetera, et cetera?
Well, I don't really try to predict asset prices in any kind of consistent way, and I don't really rely too much on technical analysis, especially as a subjective sort of reading charts type of an approach. It just hasn't done something that I found to be valuable over time, although I have plenty of friends who use it in different ways. So, I don't have any problem with it in principle if you can find a real meaningful edge. I do like the use of any kind of indicator that you can quantify and test for, whether it has predictive value. So moving averages, relative strength indexes are in principle could be really valuable. Again, I'm not aware of studies that give you fantastic risk-adjusted returns just by using some of these very widely known tools. But the basic concept of using, some measure that you can quantify and test historically, look for some kind of a meaningful edge is a great way to go, I think.
All right, moving on to our next question. This one comes in from a listener. It goes by the handle, The Analyst. This one's actually for you, Jared, so put your listening ears on. He writes, I was able to track down a copy of recent BGC research notes through a colleague. I found a comment in the most recent research note surprising given the recent statements to the contrary on volatility views. And he pulls the quote here. He says, the 1 month implied volatility of VIX options as measured by VVIX was featured in our last volatility tracker update, and the estimate remains near record lows. Given this discount, VIX options still look more attractive for equity portfolio hedgers than at-the-money SPY or SPX puts. He goes on to write, it was my impression from the last episode that the panel, particularly both hosts named Mark, took a dim view of VIX as a hedging tool, yet the most recent BGC research appears to recommend them. I very much enjoy the program. Hope you can shine some light on this discrepancy for me. Let me just clear it up before you dive in there, Jared. Yes, we did talk about this on the last episode, not this quote in particular, but using VIX versus SPY, SPX as a hedge. I've said many times in the past, I definitely prefer the more direct type hedge, but there are use cases for the latter. So, Jared, I think that's probably what you guys were getting at in your research piece, but I don't want to put words in your mouth. What do you have to say here for our friend, the analyst?
Yeah, well, you're exactly right. My call in that note, and in general, when we look at VIX and volatility products, is almost always on a relative value basis. I don't think anyone, would recommend either a VIX product or an S&P product or any other equity index or other hedging product as consistently and always the best product to use for whether it's for a hedge or anything else. In the case of that note, when looking at extremely low VIX implied volatility at that point in time, the idea there being that if you can get that implied vol exposure at a really meaningful discount to where it's historically been, then that looks like a better relative value than something you might find in an equity index. So I remember this conversation we had last week on this topic, and I was kind of playing devil's advocate there too. But I certainly see lots of instances in the market when the reverse is true, and S&P products look like a much better value for a hedge than a comparable VIX product. So really, it just comes down to what the premiums look like at a given point in time, what your hedging scenario is, whether it's a very short-term risk or something larger and more meaningful. Once you tailor your desired position for those kind of parameters, it's really more of an empirical question than anything else about where the greatest discount lies.
Well, and I think a point that Jared made last week about the elasticity of VIX hedge relative to SPX has become exceedingly clear over the last couple of days, where, even if you're buying cheap vol and you bought like a 1900 put, you're getting completely worked over as opposed to buying a VIX $15 call, which is going to be more likely to give you a real assist quickly, the VIX call or, an SPX put on a 20 point or a 30 point sell off. You're going to get a lot out of that VIX call. And so, that's the fact that you've got those low vols and that you can buy, I think does add some fuel to fire. I got to be honest, Jared, I was talking to another guy that's heavily into VIX, and that elastic hedge piece is something that, both of us have kind of we never actually put it into words. We both were like kind of like there's a value there, but it never actually kind of dawned on us exactly why VIX had that, why there were really good reasons to use VIX, and that discussion on elasticity I thought was brilliant.
Well, thanks very much. Yeah, I mean that you're right. That's the essence of the idea. I still think that, what you guys were saying last week, taking the other side of it, if your scenario isn't for a really big move in the market, there's plenty of use cases where the S&P product is actually more desirable. Like I say, I think it depends just quite a lot on the kind of scenario that you're looking to hedge.
Right. It's very dependent.
Well, there you go, Mr. The Analyst. Hope that cleared things up for you. There are use cases for both. You have to really pick and choose what suits your scenarios. We voiced our opinions here. It's up to you to make the call at the end of the day what you want to use. Again, thanks for listening to the show and for doing that extra legwork. Go out and get the research. That's pretty impressive. Well done there, sir. All right, that's about all the time we have for the listener mail for this week. But if you want to make your voice heard, a lot of great ways for you guys to do that, including surfing on over to the website, leaving a web comment there on the show notes for the show or on a particular episode, finding us via email, questions@theoptionsinsider.com. Just be sure to put question for volatility views in the show notes, like some of your in the subject line, like your fellow listeners did, or find us on social media, twitter.com/options, facebook.com/theoptionsinsider. And last but not least, I know a lot of you guys are streaming us through the app. Really easy to hit that contact, that email button right there in the app. You can do it in the actual episode. If you look at the tabs at the top of the page there, you'll see that contact, and that'll have all of them in there. That'll have Facebook, Twitter, that'll have email. It'll even have the voicemail for the show in there, and if it doesn't, we'll make sure it updated soon so that it does. So you can actually call us directly from the app, leave those voicemails, which is pretty cool. So a lot of great ways for you guys to get in touch with us, make your voices heard here on the old program. Meanwhile, it's time for us to keep on rolling right on into our final segment, the Crystal Ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, listeners, you know what time it is. It's time for the crystal ball. It's time for us to prognosticate recklessly and with wild abandon on what the future may hold from a volatility perspective. Mr. Seabass, I think we'll start with you this week. Mix it up a little bit. Which way you leaning? Which way you looking from a VIX Cash perspective, as well as any other products you want to throw into the old mix?
I think we could see like a little incremental bounce higher on Monday or something like that. But I think there's a very strong chance for a 10 handle sometimes in the next couple of weeks. And don't be surprised if somewhere around July 4th. We break the all-time low that we saw in 2006 for VIX.
If ever there was a scenario and a time frame where that could certainly happen, I would probably wager in that case as well. July 4th, probably the ideal time for us to hit some lows in that VIX trough.
Well, especially if we have that non-farm out and we rally on that on the 3rd.
Yeah, that would be the end of it.
Mm-hmm. It'd be over.
That would pretty much be the end of all things VIX. VIX of 0.0. There you go. Then it might be too low. All right, Jared, what are you watching? What are you keeping an eye on for the rest of this week from a vol perspective?
Well, aside from the drumbeat and the March consistently lower in equity implied vol, I think there's a few relative value areas to look at. We still have some residual difference between large caps and small caps as a result of the most recent sell-off that we had. Small caps still haven't recovered quite as much, and so we've been looking at long bias positions in that area, both from, you might think in terms of price terms, but also in terms of implied vol relative value. I think that the term structure in the Russell 2000 is a little bit steeper than where the S&P is, so there's maybe some value there if you want to be a seller in the front of the curve. So that's something that I've been looking at today. Other than that, it really is a situation where there are some bigger economic questions about corporate profit margins and the pace of job growth and of wage growth that I think everyone has their eye on. But outside of those questions and maybe some idiosyncratic risks, if something happens in the Ukraine, for example, there's just not a lot to be worried about, not a lot of risks to be focused on. And I think that's why you see this bid in the market. And until something meaningful happens, I don't see any reason for that to change.
All right, good stuff as always, and we'll have to leave it there because that is all the time we have for the Crystal Ball segment. It's also all the time we have for this episode of Volatility Views. But before we go, let me check in with each of my cohorts here on the Volatility Views panel, see what they have coming down the pike that may interest you until the next time we can all gather here around the old Vol Views virtual table. Starting off with you, Mark, what's coming down the pike over there at the pit?
I've got a free webinar on next Wednesday, June 11th at 4:30 Eastern, trading options in a low VIX environment. So fitting to Vol Views. And it should be a lot of fun. It's going to be me and Jill. And she's going to be doing some technical analysis stuff, some market stuff. And then I'm going to be digging into, ways to take advantage of options.
Sounds good. And Mr. Jared, what's coming down the pike? What can listeners look forward to if they want to take a sneak peek at some of the stuff you're cooking up over there at BGC?
I can give you a preview. We've got a big note coming out probably next week, looking at the returns to a strategy that uses VIX straddles to trade the market, and it's a little bit longer than what we've usually been doing, with a little more detail. So it's a big piece. I'm really excited about it, and we'll be sending that around to clients next week.
So there you go, listeners. If you're a client of BGC, you'll have it on your desk shortly. If not, maybe we'll find a way to rope some of it onto the show here, so you guys who aren't clients can benefit from some of that analysis and write in with your own comments and questions about it, as well as one of our listeners did this week. All right, and on behalf of Jared and Mark and, of course, myself, I want to thank all of you out there in the listening audience for continuing to download and stream and subscribe to Vol Views, and, of course, for checking out our mobile app and streaming it through there. I know a lot of you guys are doing that and checking it out and having a lot of fun with it. And, of course, we're sending in those great questions. Keep them coming. We love your feedback. That's the soul. That's the reason we do this program. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.